Central banks are the backbone of a nation's economy, playing a critical role in regulating the money supply and ensuring stability. Their primary functions include managing inflation, overseeing monetary policy, and serving as a lender of last resort. By controlling the amount of money circulating in the economy, central banks can influence interest rates. For instance, when they lower rates, borrowing becomes cheaper, encouraging spending and investment. Conversely, raising rates cools off an overheated economy. This decision-making directly affects everything from your mortgage rates to the price you pay for goods and services. In essence, central banks act as the steering wheel of economic policy, directing how fast or slow the economy moves.
One of the most direct ways central banks control your life is through interest rates. When the central bank adjusts these rates, it affects how much you pay on loans or earn on savings. For example, lower interest rates often mean that you can secure a mortgage at a more affordable price, facilitating home ownership. On the flip side, if rates are increased, your credit card payments could rise, making it more expensive to carry a balance. This ripple effect creates a direct link between central bank policy and your personal finances. Understanding how these rates are set can empower you to make smarter financial decisions. Always keep an eye on central bank announcements to gauge how your financial landscape might shift. Inflation is another crucial aspect where the influence of central banks becomes apparent. When central banks print too much money, it can lead to inflation, eroding the purchasing power of your dollar. This means that over time, the same amount of money will buy you less than it did before. Central banks aim for a low, stable level of inflation to maintain consumer confidence. However, when inflation rises unexpectedly, it can lead to higher prices for everyday goods and services, impacting your budget and savings. Learning how to navigate inflationary periods can help you protect your finances. Strategies like investing in assets that historically outpace inflation can be effective in preserving your wealth.
Central banks also play a significant role in influencing employment rates through their monetary policies. When interest rates are low, it encourages businesses to borrow money, invest, and expand their operations. This expansion typically leads to job creation. Conversely, high interest rates can stifle growth, leading to layoffs and decreased hiring. The employment rate is closely monitored as an economic indicator, and central banks use this data to adjust their policies accordingly. By understanding this relationship, you can appreciate how central banks indirectly affect job availability and ultimately your career prospects. Lastly, central banks don't operate in a vacuum. Their policies can have far-reaching effects on the global economy. For instance, decisions made by the Federal Reserve in the United States can influence currency values and interest rates worldwide. This interconnectedness means that central bank actions can impact your life not just locally but internationally. Changes in foreign exchange rates can affect the cost of imported goods, travel expenses, and even international investments. Being aware of how these global dynamics work can provide you with a broader perspective on your financial decisions.